Hey everybody, it's Jane Johnston with the Briar Hill Group at Remax Camosun, host of Vancouver Island Time. Today I'm here with Jennifer Lowe of the Modern Mortgage Group. Hello Jen, how are you?
Good. How are you?
Awesome.
Good.
So it is June and June 10th, I believe, right? Yes.
Yeah.
What are the major changes happening on the horizon for mortgages?
Yeah. So on Friday, it was announced that CMHC is going to make three major changes to their guidelines starting July 1st. Those three changes are the one that's going to affect the least amount of people is the removal of their flex down program, which
Flex down?
flex down. So basically what that means is the ability to use borrowed funds towards your down payment.
Is that
So
from your parents, so that you have to have a gift letter?
no, this would be using like an unsecured line of credit, doing a cash advance on your credit card, that kind of thing for your down payment.
Okay.
Very rarely, it never made sense, honestly, because the qualification in order to qualify to be able to do a flex down was very difficult. So
Okay.
least affected, or least amount of people are affected by that change. The second change that is coming into play is from a credit standpoint. So the minimum credit score for the primary borrower, and the primary borrower is the main income earner, has to be at minimum a 680 beacon score.
Okay. And what do most people come in at?
Well, this is the interesting thing is going back a few years, anything, a beacon score, credit score above 680 was deemed to be in the excellent category.
Oh, so it has to be excellent for the primary borrower.
Yeah. So now literally you have to have excellent credit.
Okay, to borrow money. Okay. Next.
So, and just to expand on that a little bit, with keeping your credit, for those people to know, the biggest thing to keep your credit where it needs to be is to keep your balance on your credit cards below 65% of the limit. So
Okay.
if that means getting a credit limit increase, or if you can't pay it off, but keeping that balance below 65% of the limit and making at least the minimum payment each month.
Okay, so you want to, hi Paula. You want to make sure that if you look like you're getting, I know that I go up, I deliberately lowered my credit limit because I didn't want to, they were giving me way too much money. So really I was at an advantage because let's say I have a $30,000 credit limit, then I don't want to go higher than 16,000 or whatever.
Exactly.
Okay. Is that the third thing, or is there a third thing?
There is one more thing. The third thing, and the most significant change, is the reduction to people's purchasing power, or the amount they qualify for. So there's two ratios that come into play, your gross debt service ratio and your total debt service ratio. To break that down, it's the amount of your total income, your gross income, that is put towards your monthly obligations. So that those ratios have decreased from 39.44. Sorry, this is kind of a little bit technical, but 39.44, it's decreased to 35.42. So in English, it's taken away basically prior to the CMHC change. It's reducing your purchasing power by about, I've written it down, 10%.
Wow.
Yeah.
And this is because they want to make sure people don't get into financial trouble, I think.
Yes. They're kind of. The understanding is the reason why these changes were put into place is because that CMHC, quote, failed to increase the supply of houses being for sale. So instead, now that what they've done is they've made it harder to qualify
Right.
to reduce the amount of buyers available.
Right.
So,
But last month you were telling me that they were relaxing some of the rules and allowing things like child benefits to go towards income and stuff like that.
that's the lenders. The
Oh,
lenders.
the lenders.
Yeah. So when you have less than a 20% down payment, there's basically a two-step process in obtaining a mortgage approval. So this change by CMHC is only affecting those buyers, those people that want to purchase, that have less than 20% down.
Okay, can't put more. This affects those who can't put more than 20% down.
Right. Now, further to that, so normally when CMHC makes these announcements and makes these changes, there's two other insurers that are smaller and private companies that historically have always followed suit whenever CMHC makes these changes. They adopt the same policies that CMHC has made.
Right.
So this is a first that Genworth and Canada Guarantee have not made the same policy changes. So
no, I'm just wondering if we look at competition, good old competition, we shouldn't just be following what they're doing anyway, right? We should be providing an alternative to people.
Yes. And there's always been a few slight difference in their policies. Biggest one, CMHC has never liked illegal suites. Genworth is okay with illegal suites. CMHC is fine with age-restricted buildings. Genworth doesn't like age-restricted buildings. So there's a few that depends on which insurer you go to, but this is the biggest thing that I've seen from a specific policy with qualifying ratios.
So whereas Genworth and Canada Guarantee are private companies, CMHC is funded by the government, right?
That's right. Yeah.
Okay. Alrighty. So we know that it's going to reduce purchase power for those who have less than 20% down by about 10%. So if somebody's looking for a condo for 400, they're now going to be looking in the 360 category.
Basically, yeah. Now, that's only with CMHC. So by Genworth and Canada Guarantee currently not following suit.
Currently.
We don't know when and if they will. I think they'll probably see how it affects the market, how much of an increase in business they get. The really disappointing piece is that the people that this is going to affect are those first-time home buyers that are trying to get in at the lower end of the market, trying to get to the condo.
The market for condos did drop. Yeah. So it went down 15% during March, April. It's bouncing back, but okay. I can discuss that in depth at another time. So it might be okay. The other thing is so if we're looking at gross debt service ratio, we're not only looking at the cost of the condo, we're also looking at what the condo fees are.
That's right.
And there's a double-edged sword to that, right? Because if you have low condo fees, you're likely to have a lack of repairs in the condo. Whereas if you have a reasonable condo fee and you have a good contingency fund, those are issues that these insurers are also looking at as well, right?
Oh, yeah. Yep. They review strata minutes. There are properties that are, they say red flagged, that, have issues and opted out of obtaining a depreciation report back in 2012, for example. No, that was not a good choice back then. If the condo or the strata is managed privately. Those are kind of the ones that normally decided to opt out of the depreciation report, as they didn't have the education or the understanding the importance of it, which just created a bit of a domino effect.
Right. So in 2013, things changed, rules changed, and condos were required to have a depreciation report, which looked at the cost of capital repairs over the next 30 years. And it was really the tail wagging the dog, because at that point, buyers were wondering what the financial picture was of different condo buildings, whether or not there were any special assessments coming up. So it's a really important picture to give a buyer, because if you buy a condo and next year you're going to have a $10,000 special levy, that's a big deal.
Huge. That's a lot of extra money if you're just getting into that condo, to then have to come up with an extra $5,000-$10,000 for whatever the repair is. That's a major stress.
Okay, so what are some key dates to buyers that they need to know about?
So July 1st is when these changes are being implemented by CMHC. They do say under some circumstances, lenders implement the changes earlier. I don't see that happening this time, because Canada Guarantee and Genworth are not following suit. But the key is we don't know how long they will not follow suit. So as much as like a panic was created on Friday with this, it was like, oh geez, this is a huge change. All my clients that I have pre-approved, we need to go back and revisit their figures, right? If they don't find something in the next month here. But then it's lovely that Genworth and Canada Guarantee chose to not follow suit right now.
Right. So what they're doing is they're shifting
The market.
Yeah, this isn't a smart move when I think about it, because really, if we want to stimulate the economy, we want to have money going through, and we want the government to have the money going through, right?
And the Bank of Canada's outlook was good. Our chief economist was happy with how things had been moving along in the last month. We're getting better. So to have this with the idea that they're wanting to now, and they failed at increasing the supply, so now they're going to restrict buyers. People are not happy about this mindset.
Okay, so what about those who are on the edge of that 20% and want to move and are porting that mortgage? Obviously, if they're going to incur a penalty if they don't carry through in their mortgage, sometimes the penalty can be quite significant, correct?
That's another change that really has since the pandemic. So there's two penalties, right? If you have a variable rate mortgage, at worst, you're looking at a 3-month interest penalty. If you have a fixed rate mortgage, it is the greater of either the 3-month interest penalty or the interest rate differential penalty. And that interest rate differential penalty looks at the current 5-year posted rate and takes into consideration the discount that you received off of that posted rate. What has happened with Bank of Canada dropping prime rate as low as it's dropped, the posted rates have dropped, and that penalty has skyrocketed from literally 1 week to the next. So
actually there was an article I posted about a lady who had a $30,000 penalty.
Yes,
that's incredible.
In Ontario. And literally, she could have checked one day. You find out what your penalty is. Day later, it can change. And they always say to you on the phone, this is only good for today. It can subject to change. And we've seen these huge increases in the penalties across the board with the majority of lenders on fixed rate mortgages. So when someone is looking to sell their current home and buy another home, it is important to consider porting your mortgage, taking your mortgage with you to the new property, which is basically what you're doing. You can increase the mortgage, do a port and an increase.
A blend and extend.
Yes. I mean, there's all these terms, right? But at the end of the day, you're making it so you don't have to pay the penalty.
Right.
What we do is, depending on what rate you're at, how much of an interest cost that's going to be until the end of your term. I will do calculations to see, does it make sense to pay the penalty or not, to get another rate. Now today, I mean, we're at really low fixed rates. They've been dropping consistently.
What are they right now?
For an insured mortgage, 5-year fixed, we can get it down to like 2.29.
Ooh, so 5-year fix, what that means is that it is not variable. It is a fixed rate mortgage, so you are likely to have the big penalty. Can you explain the penalty with a fixed rate? Paul is asking.
Okay, so if you're going, with a fixed rate penalty, so let's say you lock in today at 2.29%. You, in 3 years, want to get out of your mortgage. And at that point in time, rates are lower. They're down to 1.69, for example.
So the bank is going to lose money.
Yes.
Because now the rates are lower. What if the rates go higher?
If the rates go higher, more than likely you'd be looking at a 3-month interest penalty.
So if your mortgage payments are $1,600 a month and you're paying $800 in principal and $800 in interest, it's 800 times 3 months, which is $2,400.
That's right.
I should be a mortgage broker.
Where people are really seeing these higher penalties right now is that if you got a mortgage, say just about a year ago, you're at 3.19 and you're wanting to refinance into a lower 5-year fixed, those penalties are not pretty, right?
And just saying, I bought a place just before this all hit, the Monday before the Friday we all went into quarantine.
Yes.
So,
and your penalty would not be pretty. I'm
no.
sorry, it sucks. Yeah. And the variable rate, when you if you Google 5-year, variable versus fixed, historically, the 5-year variable has always done better than the fixed. We were in a unique time there for a little while where the variable rate, right before the pandemic, the variable rate dropped 1.5% literally in 3 weeks. The variable rate was actually higher than the fixed.
Yeah.
Why would, it didn't make sense. And who would have known that we were going to have what we had happen in 3 weeks, prime rate dropped 1.5%.
Okay, it's saying we have 2 questions here.
Mm-hmm.
That is a buyout rate penalty. That's what she's saying?
Yes. So you will see, and I'll make an assumption there. With there's currently, you'll see really low rates being offered right now with like 5-year fixed rates. Some of those rates being offered, the only way you can get out of that mortgage is if you sell your property. The property is sold, or penalty can be up to a 3% of the balance of the penalty of the balance of the mortgage.
So give me numbers here.
So let's say you've got a $400,000 mortgage, right?
Mm-hmm.
Your penalty. So there's some restricted products. You'll see, let's use HSBC. They've just come out with a really low mortgage offering of 1.99%. Sounds great.
Until you look at the details.
Yes. Yeah. Their penalty calculation, and I don't know for sure, but usually it's higher and can be up to 3%, or based on a different rate, which makes the penalty higher.
Okay, so you're good until you want to get out.
Exactly. So it's fine print that you don't necessarily know or think about until 3.8 years, which is the average that people move. Most people move prior to the end of the 5-year term and want to get out of their mortgage, whether they're going to be moving, downsizing, moving up to a different house that suits their family better. Yeah. So when that penalty comes into play, to go back to the previous question, it's if you want to get out of your mortgage prior to the 5-year term.
And you're not buying again.
Yes.
Okay, within 3 months usually.
That's right.
Or there's no porting clause. Okay, Kevin is asking, do all new buyers have to go through a mortgage broker? I'm going to answer that because this is what I say, and you can tell me if I'm right. I think they need to go through a broker. And the reason is, if you take a matrix of all the different lenders and you look at all the different products that there's, your child or whomever, the first time buyer, is going to fit into certain different companies, and there's going to be different rules and regulations and different ways of qualifying. Different lenders look at things differently, right? So when what Jen does is she does one credit check and then one application, and she sends it out and she shops the market for you, correct?
Exactly.
So you want to go through a broker because there's no penalty for using a broker. In fact,
no cost. It's free.
There's no cost, exactly. And it's cheaper for the bank to use a broker than it is to use somebody at the bank. And anybody who works at the bank, don't kill me. But I will tell you that with my clients who have used the bank, sometimes the people at the bank aren't working on the day that we're doing the subject removal. And I have been left wondering with my client whether or not to remove subjects. So I would say, go with a broker. They're incentivized. They get paid by the lender, right?
That's right. I mean, we have access as a mortgage broker working under the Dominion Lending umbrella. We have access to 40 plus lenders. What I do like to say is I have relationships with about 10. So I work regularly with 10 lenders. I've had the same underwriter for 8 years with Scotiabank that I just love her. You create a relationship, and you're working together. We all like to work with people that we know, like, and trust. And it makes my life easier, which in turn makes my client's life easier and everyone else involved when things are happening in a timely manner.
And I think what's also really good is if there's really good communication between the realtor and the broker, and then the broker and the underwriter, is you're all working as a team to make it work through. And often I would go with a local broker as opposed to one across the country, because there's little nuances, local nuances, don't you think?
I mean, ordering an appraisal is one, right? Having the connections with getting an appraisal done as soon as possible if needed. Having the lawyer connection as well. Creating basically a circle around our clients to make it as stress-free of a time as possible.
Okay, so Kevin says his son, Kevin, I'm happy to sit down with your son. And what we would do is we set up a meeting between Jen and your son, and I'm sure you're going to get a million messages from realtors now. Kevin's a client of mine, super nice. Such a nice family, by the way. So what you do is I recommend, if you are going to purchase a house in a year or so, that you set up a relationship with Jen now, because what happens is, and what I do is I put together the list of everything I think she needs, and then I put it in a Dropbox folder. So if I have a paycheck stub, it goes into the Dropbox folder. If I have a notice of assessment, it goes in. So I had notices of assessment for, like, I don't know, 6 years already, right? They were already, I just handed her the folder link, and then she went ahead and then she told me what I was missing, and we provided it. So I'd like to think I was easy. I know I wasn't, but
yes. No, it's wonderful. I mean, it makes my life easier when I'm able to obtain the documents from, and I try and do it all the time. I like to give you a laundry list of documents to obtain from you up front, and then I'm not having to come back to you and ask for additional documents later on. I just like to get it all up front, and then we know exactly what the numbers are that we're working with. Those are firm numbers then, as opposed to, wondering if it's plus or minus $10,000 on your income or what have you. So
Okay, I have another question for you right now because we're dealing with an offer on a property. Um, how many days do we need for financing right now? These are the questions I would ask when I'm working with a buyer. So
Yeah.
I'm working for the seller, and we're negotiating the days to remove conditions. So how many days does a buyer need now?
I like 7 to 10 days.
Okay. So today's Wednesday. So next Friday is 9 days.
Yeah.
Okay. All right. I'm going to tell them.
I would be happy if I saw that. Yeah, definitely. I mean,
Okay.
there are times that it can be done very quickly if necessary. But honestly, it goes back to the relationship with the lender. I received a last minute deal on a Friday afternoon at 1:00. The client was declined by their bank. Subject removal and it was a long weekend. Subject removal was on the Tuesday. I was able to get an approval by the end of the day on Friday. And then Tuesday, we were able to remove those conditions. And it was me saying to my underwriter, please, I know it's Friday afternoon, but can you please look at this one? And we were able to get it done. It's huge.
I'm wondering if that was my client. Anyway, okay. Is there a limit to buying a house with a mortgage?
No, lenders are not allowed to age discriminate.
Yeah, and I think it just depends, right, on income versus like just looking at your how you're going to service the debt, correct?
Yes, for elderly clients, it is a great consideration to consider reverse mortgages. There's been a lot of old myths around reverse mortgages over the years, but they've definitely come around and are a great product for elderly clients. The other thing, and I was going to touch on, I wanted to touch on property taxes.
Right. I'm just seeing, yeah, they're due July 2nd. And so are they being deferred this year?
No, they're not. I haven't heard any. It'd be great if they were being delayed, having to make payments. One thing I don't know if people know is that once you're 55, you can defer your property taxes.
I forgot about that.
Yeah, so that's something that a lot of people don't know.
I would not do that.
It depends if you're on a fixed income. People that own their house outright, for example, have that equity in the home. If you've got some cash flow challenges, it's something that may help relieve that stress. Definitely just wanted to remind people to complete their homeowners grants online, and then lenders, you can have your lender pay your property taxes with your mortgage.
Yeah.
So it's good. Nice to not have to come up with the full amount of the property taxes for July 2nd.
Yeah, and how you know that is they should have your mortgage number on your property tax assessment. So I'm just looking here to see, because I did get my taxes, how to pay. Yeah, I don't see any deferment. And the city has to run the city. So I don't think I don't think it's a good idea to defer. And the reason why I don't think it's a good idea is because I see people who have deferred, and it's $5,000 and they've deferred for 10 years. And that's a big chunk of cash.
The other thing is that if at any point in time they want to do a refinance or want to take equity out of their home, that money has to be brought up to date. So you have to pay your taxes up to date at that point in time, and people forget.
Okay, so anything else you want to say? We're already at half an hour, believe it or not.
That was great conversation. No, I'm available anytime. If anyone has any mortgage related questions, I'm happy to help.
Okay. And as I said, I highly recommend Jen. I've worked with her probably for about 10 years now. So if you want to get in touch with her, you can go to JenLowe.ca. And my clients who work with her like to say she's not the Jen Lowe. J-Lo. You
I
can
know.
reach her at j.lowe@dominionlending.ca. She works with the Modern Mortgage Group, and they are located at Uptown Mall, correct?
That's right.
Okay, or you can give her a call, 250-217-4925. If you want to know what's happening in the market in your area, I actually did a fabulous update, which I'm happy to send you. Just message me and I'll forward you the video. It gives you a very robust review of what's been going on in the market for the last few months. We have another comment here. Thank you both for the great information. You're welcome, Paula. It was nice chatting with you. Thank you also, Kevin, for visiting with us. And tomorrow, we'll see. I don't have a guest yet, so if you're interested, let me know. If you run a local business, I'd be happy to chat with you. And on Friday, we're going to be talking with a lady who has moved here from Turkey. Her name is Begum, and she is going to be talking about landscaping, which is very important for first impressions in homes. All right. Thank you so much, Jen. Take care, and we'll see you later.
Bye.
Bye.